Yo, what's good everybody? Welcome back to another video on the Day Trading Institution. So we're going to start getting more into the technical aspect of trading and really learning about technical analysis within this section. So first things first, what we got to learn about are candlesticks. So we're going to be going over the candlestick Bible is what I like to kind of call it. So in this lesson, we're going to cover pretty much just the anatomy of what candlesticks are and learning about the candlestick itself. In the next video, we'll go more in depth on candlestick analysis. And then doing multiple chart breakdowns on candlesticks and literally just going over candlesticks. And then we'll have another section later on the best entry candlesticks, which I know a lot of people will be very interested in seeing. So let's just kind of get started. So what is a candlestick chart? Why do we use them? Basically, there's a lot of charts that are offered to you when you're actually trading either the stock market, cryptos, whatever you're trading. The candlestick chart is the best chart in my opinion. Pretty arguably, I want to say, just because the amount of detail that the candlestick chart would can actually give us in between the high price, the low and the low price, the open and the close of that trading session, so on and so forth. So a candlestick chart is another form of reading market data within the financial markets. It's literally as simple as that, but like I had said previously, it is one of the best charts that we could possibly use. It is better than the Renko chart, it is better than the line chart, and any other chart that's out there, just because the amount of data that we can interpret as traders when performing our technical analysis in the market. Now, we as traders use candlesticks compared to other charts because it shows us the most data within price fluctuations. It's literally as simple as that. There's no need to overcomplicate it. Now, let's cover the candlestick and the anatomy of the candlestick. So when we talk about candlesticks, we need to understand a few things. We're going to have two types of candlesticks. We're going to have a bullish candlestick and a bearish candlestick. A bullish candlestick means that they're simply buying volume. This is a buyer's candlestick. A bearish candlestick means that there is selling volume, and this is a seller's candlestick. Now, there's going to be four main aspects to a candlestick. You're going to have the open, you're going to have the close, you're going to have the low, and you're going to have the high. Now, within the candlestick, you have the body of the candlestick, and then you have the wicks of the candlestick, right? You got to keep one thing in mind. Every single time frame is going to have its own set of candlesticks, because you have to remember, if you're on the daily time frame, each candlestick represents 1 day of data. If you're on the hourly time frame, each candlestick represents 1 hour worth of data, right? So when it comes to a bullish candlestick, right, there's two things that both candlesticks have in common. Is going to be the high and the low of the wick. Those are the two main things. If you take a look at both the bullish and the bearish candlestick, you're going to see the open and the close are the exact opposite. But when it comes to the wick, which is this black line, the high and the low are going to be exactly the same. So those are pretty much one of the main differences between the bearish and bullish candlestick, right? Typically in the market, when a bullish candlestick closes, right, the bearish candlestick will open up shortly after that, right? So we want to think about it as whatever this candlestick closes, the next candlestick will open where the previous candlestick closed. So I'm going to repeat that one more time, right? Whenever a candlestick closes, the next candlestick will open where the previous candlestick closed at. So if gold closed at 1701, let's just say it's a daily candlestick. Let's just say on the daily time frame, gold closed at 1701. The next candlestick will open up at 1701, and you have to wait 24 hours in that situation for the next daily candle to actually close, right? So again, we have the high and we have the low of the candlestick. Now, obviously, this is going to be the low because it is the lowest portion of the wick, right? When it comes down to the low itself, anything under the open is going to be considered a low. Anything above the open is going to be considered a high. Now, each candlestick has its own time frames. Depending on the time frame of the candlestick, it will relay different data for us to interpret and hypothesize market direction based on the previous candlesticks. Now, what we're going to be talking about, as I mentioned in the last slide, is going to be the candlestick wick, which is pretty much just going to be these sticks that the candlestick actually forms for us, right? Now, typically, when we look for wicks, we typically call them wick rejections. We can also call them exhaustion, but typically, we're going to be looking for really big wicks at key levels, which we'll learn later on, at areas of supply and demand, at areas of support and resistance. Why? Because it shows us that price is slowing down and could potentially reverse. So candle wicks show us the low and highs of that candlestick. You could also say the lows and highs of that trading session, or that trading day. But again, you would have to be really, direct in terms of what candlestick you're looking at, right? So looking at the daily time frame, the wicks will show you the low of the day and the high of the day. Looking at the 4-hour time frame, the wicks will show you the 4-hour session wicks will typically show you the highs and the lows of the last session that 4-hour candle may have opened or closed on. And typically, like I said, other than rejections, we use the wicks to tell us the high and the low price. We also use them to mark off the higher highs and the higher lows, or the lower highs and the lower lows of the trend. And wicks are just areas where we could also see liquidity within the market. Now that we know what the anatomy of the candlesticks actually are, let's go over strong, weak, and neutral candlesticks. So we're going to be able to use this information here to identify entry points in the market. We're going to be able to use this information in terms of identifying if a candlestick is strong, weak, or neutral, to look for potential reversals, to see if the trend is still holding with momentum, to see if a level of resistance or support may break. But overall, we need to be able to identify if a candlestick is strong, weak, or if it is neutral, so that it can only benefit us with our trading later on. And you're only going to be able to get better at actually reading these candlesticks with experience and actual chart time. Chart time is so important, showing up to the market every single day, consistently trading every single day, and looking to gain at least 1% better every single day. You'll only be able to understand these concepts a lot better in the future. In the beginning, you definitely may feel overwhelmed, but there's gonna get to a point in time in your trading where everything is it's just gonna kind of click for you, and everything is gonna start making sense, right? So let's go over strong bullish candles. Now, what I like to do is divide the candlesticks into 3, right? So we have a total of 100% of a candlestick, but we divide it into 3. So we have a strong bullish candle is when a candlestick closes within the top third of the open to the high of the wick, right? So if we look at this example here is the open of the candlestick, and then here is the high of the wick. If we were to see where this candlestick closed, because again, a bullish candle will open at the bottom and close at the top, and then close bullish, obviously, right? If we look at the space from where the candlestick again opened to the high of the wick, I would say it closed within the top third from the open to the high. So if we were to grab a ruler and or if we were to measure this and grab this and say this is 100% of what we're looking at, and the candlestick closed here, I would say it closed within the top 90% of what this entire candlestick, of what this entire bullish momentum was or is, right? Now, one thing I want you to keep in mind when determining if a candlestick is either strong or if it's either weak, we're only looking at the close to the high, and that's with a bullish candlestick. With a bearish candlestick, it's going to be the opposite. We're going to be looking at the open to the low, but in a bullish candlestick, we're going to be looking at the open to the high of the wick, right? So a strong bearish candlestick is pretty much the same thing, just vice versa. A strong bearish candle is when the candle actually closes within the bottom third of the low from the open to the low of the wick. So if we look at this bearish candlestick here, the open is going to be right here where this candlestick actually starts. Notice how it closed from the bottom third of the actual wick. So I'm going to go back really quick, right? A bullish candlestick, we're going to measure the bullish candlestick from the open to the high of the wick, right? We're going to measure a bearish candlestick from the open to the low of the wick, right? So notice how this candle closed within the bottom third. This is going to be a very strong bearish candlestick. Now, things that make this candlestick even stronger, notice the big bullish wick that it left, right? And then notice how price came all the way down and closed within the bottom third. When a candlestick leaves a big wick in the opposite direction, you want to think about it again as a tug of war, right? At one point in time when this candlestick opened up, right, the buyers were winning the tug of war, but before the candlestick closed, sellers came into the market and ended up winning the tug of war. And look at the amount that they had to push price all the way down. Now, sometimes this may not be significant on the lower time frames, but candlestick like this always show us which side may be a little bit stronger within that specific candlestick. And we can use this information to, again, help us hypothesize market direction overall. Later on, we're going to be using all these concepts together. But as of right now, I just want you to understand the principle of the candlestick, right? So again, we're going to be looking at the open to the low, and notice how this candlestick closed within the bottom third. Now let's look at a weak bullish candlestick, right? So a weak bullish candlestick is when the candle closes within the bottom third from the open to the high, right? So a bearish candlestick, we're measuring from the open to the low. A bullish candlestick, we're measuring from the open to the high of the wick, right? So I know that may be a little bit confusing because I said it closes within the bottom third. But again, we're not measuring the low here. We're measuring the open to the high. And notice how it closed within the bottom of the open to the high, within the bottom third quarter of the actual candlestick movement here, right? So again, we're measuring from the open to the high. It's literally as simple as that. So the fact that it closed within the bottom third of the candlestick simply tells us that at one point in time, buyers are trying to push price higher, but sellers brought price all the way back down and it closed within the bottom third, leaving us with a very weak bullish candlestick. You could definitely argue and say that at one point in time, buyers were winning the tug of war battle, but then got very weak and then closed near where the battle actually started, ending the battle off at the bottom third, showing us that it is very weak. Typically, those are not the best entry signals. Now, a weak bearish candlestick is pretty much the same thing, just kind of vice versa. So a weak bearish candle is when the candle closes within the top third from the open to the low. So again, we're always going to open up around the same price, but the difference when we're measuring a bearish candlestick is we're measuring the low. Compared to the bullish candlestick, we're going to be measuring the high. So notice how from the open to the low, price came all the way back up and it closed within the top third of the actual movement from the open to the low, showing us that this is a very weak bearish candlestick. Again, I can use the same exact tug of war example where at one point in time, sellers were very strong, but then buyers came back into the market and they ended up pretty much finishing where they started, showing us that sellers were very weak. So again, you can think about everything as literally a tug of war battle. Now let's go over some neutral candlesticks. So when we go over a neutral candlestick, it's more like an indecisive. There's definitely a lot of indecisive players or participants within the market at this point in time. Not that you want to disregard it, but just know like it's not weak nor is it strong. Again, it's indecisive. It's right in the middle. So a neutral candle is when the candle closes within the middle of the open to the high. And this is a bullish candle. So notice how the candlestick opened up here, went all the way here, but closed, I want to say it's a little bit under halfway there, but it's definitely in the middle range compared to the bottom of the range. The same thing when it comes to a bearish candlestick. Now notice again, a neutral candle is when the candle closes within the middle of the open to the low. So notice how price came all the way from the open to the low here and it closed within the middle section. Now let's cover momentum. So we need to be able to identify momentum just so we know how strong a specific side is, if buyers are strong, if sellers are strong, along with when we really understand momentum, we know how long we would be able to hold our trades for, and we could see where the probability of price traveling to would be in terms of how far it can actually go. So the more momentum that there is within the market, the farther a trade could run. If there's not a lot of momentum in the market and you're in a buy position and you see that there's not a lot of momentum in your favor, it's either one of two things. Either you're outside of a big trading session because you're going to see more momentum within a bigger trading session, such as the London session or the New York session, or there's just simply not a lot of volume on your favor and you may be wrong. Now, does that mean that when momentum is low, it can't pick back up? Yes, it doesn't mean that. But at the same time, when it comes down to momentum, things could literally change from 1 second to another. I literally at the snap of your fingers, within seconds, things could change. At the same time, though, when you're actually looking at a trade and you're looking to hold a trade for a big move, you're only going to have a really big move in a short amount of time with a lot of volume and momentum. Now, momentum or volume simply determines the amount of orders that are being put into the market and the speed of which those orders are entering the market. That is the definition behind momentum. Right, so now let's cover low versus high momentum candlesticks. So low momentum candles are candles that have very low volume and aren't moving very fast. You could think about low momentum as small candlesticks and high momentum as big candlesticks. The bigger that the candlesticks are, the more momentum and volume that candlestick has, right? Vice versa as well. The smaller that the candlesticks are, the smaller that there is in volume and momentum. So again, when you're reading momentum can come into our favor in a lot of things. When you see momentum start slowing down at an area of resistance, you can almost expect price to have a big reaction to the opposite direction. Meaning that if bearish momentum is slowing down at a level of support, you can anticipate that level of support to break. And it's fairly simple. Really, it's just a simple concept at the end of the day. But now when it comes to high momentum, it's the same exact thing we literally just went over with low momentum, except it's the opposite. So sometimes, like I said previously, you're going to see momentum be fairly slow and then things just randomly pick up when the market sessions start to open, such as the London or the New York session. So high momentum candles are candles that have a very high volume and are moving extremely fast. So the example to the left is going to be a bearish candlestick that has a lot of volume and momentum. And the candlesticks to the left or the right are gonna be a bullish candlestick that have a lot of volume or momentum to them. So in the next couple of lessons, we're going to be going over a lot of examples of high momentum candlesticks. We're going to be going over a lot of examples of the candlesticks themselves, strong, weak, bearish, bullish, neutral candlesticks, along with entry candles, and just looking for multiple examples. Again, these are all very simple concepts. They're just put together in different situations, and that's what trading is. They're just a bunch of simple concepts put together, and the only thing that will make you better at trading is time and experience.